Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. In this video I want to go over a very low delta, almost two standard deviations low, futures trade using the MES futures. That mimics the S&P 500. And we're looking at really low deltas, 0.03 to zero 0.5, very high likelihood of success on these trades. You could get a pretty decent return too, looking at 2 to 3% a month on a lot of these trades. We're going to go over the strategy, why we actually do it, what MES is a little bit more, and then how to possibly manage these if it doesn't go your way. As always, like, subscribe, share, definitely helps out the channel. Appreciate all of your support, and let's get right into this. Alright, so if you've seen any of my previous videos I made recently on the 111 trade and how to manage the 111 trade, there are some pluses and minuses to that over what we're about to see on selling just the naked put. One of the pros is the possible profits would be higher in the put debit spread part. However, I'm a little queasy about those naked puts that have a high delta around 0.08, 0.09 at times just to cover the PDS. So what I typically prefer to do is just simply sell a naked put at a much lower delta that still returns an adequate return, and I'm typically looking for 2% a month on my money. That includes the buying power needed to start the trade, and I leave an extra same amount in cash. So if the buying power needed is $300, I'm going to leave an extra $300 in cash and not trade it. So again, I'm looking for 2% a month, which seems very reasonable in these very high probability trades. So let's just go right into the strategy. Okay, so this is the reason why I want to be selling MES futures options. I left a link to these notes in the description below the video. So what is MES and why do we want to use it? So this is the micro E-mini future and it mimics the SPY, but as you'll see, you could use a lot less funds in order instead of just selling an SPY put. Now use a span margin, which is similar to portfolio margin. If you do portfolio margin on SPY, do need at least $100,000 to do that. But with these futures, you could actually do this with as little as $2,000, I think, in order for your brokers to approve it. So you could use very small account sizes. It does use leverage to get good returns. And as you'll see, the strikes are relatively safe. And there is some tax advantages here. For futures contracts, you get 60% long-term capital gains, 40% short-term. Definitely consult your CPA for any tax advice. So the main goal in this strategy is to earn at least 2% selling far out of the money MES naked put options. Now, typically you want to sell puts around 0.03 to 0.05 delta. It's very close to two standard deviations away. So very high likelihood of success here. It uses around $1,000 per position in many cases, and that includes the buying power you need plus the cash you need on the sidelines. You don't want to just use the buying power and overload your account because the span margin could have you get margin called on that. So definitely leave some cash on the side when you're doing these. And then you're just going to sell the put and let them expire worthless. Commissions are pretty high on these. For Thinkorswim, you're paying $225. So when you're closing that, you got to be careful because the commissions will eat a large percent of your profits there. You can do these once a week. Actually, do these once every day if you want. And it's very easy to implement. It takes a minute or less, especially if you're going at the natural price. You will get filled pretty much automatically. Now here's a strategy. I tend to do it around Monday just to keep it consistent each week. Around lunchtime or so, let the market stabilize a little bit. You're going to sell the 0.03 to 0.05 delta put for at least 3 in premium. That's what the actual option chain will say. So it is a 5 multiplier. So if you do 3 times 5, you would get $15 in actual premium minus your $225 in commissions. And you want to get the closest to 30 DTE. Sometimes it'll be a little bit higher, a little bit lower. You might have an occasional multiple position. If you happen to sell one around 35 DTE, the next week might still be around 27 DTE. You're going to let this expire worthless, again, to save on commissions. And you want to leave the same amount of initial buying power in cash, at least that much. So again, if you're using up $300 in buying power, save at least $300 in cash, because if it does go against us a little bit, you're going to need to have more funds available due to the span margin. But in every case I've seen so far, if you leave the same amount in cash, you should be good. When the contract expires, you'll have more funds in your account at that point. Just add another one and keep it going. This is the trade that I'm looking at on the 25th, or it could be 26th of June. So you're going to be selling out the 34 DTE in this case, 3050 put, and you can make 3.15. It's at least 3 in the premium. Max profit will be $15.75 minus the $2.25 in commission, so you're looking at $13.50. And the buying power effect is very low right now, only $226. This will probably change in the middle of trading day. So we're going to leave again another $226 in cash plus the initial buying power $226. So the total cash needed for this trade is only $452. You're making $13.50 out of $452, and you're looking at a 3% return on your total buying power in cash in 34 days. It's a little bit higher than the 2% a month goal that we're trying to make. And typically you want a slightly higher than 2% goal when you do need to manage a few of these. These are the trades that I've made in the last month or so. Again, notice every week I'm selling MES futures. Dates sold 523, 25 DTE. And then I'm writing the stock price and the strike price. If you compare these two columns, the strike prices are quite a bit lower than the stock price because we're going at these really low deltas. These are the premiums I received. A little bit higher premiums than the example I just showed. That might be based on the VIX being pretty elevated. This is the money I've collected per position. And this is the buying power plus cash needed. So again, the initial buying power times 2. And then the deltas, I was looking at 0.03, 0.04 deltas. The last two I made expired. To get your percent return, just take your money collected, divided by the buying power plus cash, and you get your percent returns. Still have 3 more going right now, and going to be looking to add another one on Monday. So your total funds needed, we're going to assume a little bit more conservatively here and say that each position uses about $1,000. You're going to need to have at least 1,000 times 4 if you want to do these each week. So it'll be $4,000 in total buying power in your brokerage if you want to do them every weekend. These can easily scale if you have a bigger account. You can just do multiple contracts. You can also look into the ES futures if you have a pretty high account size. You will save a little bit on commissions compared to the amount of premium you're receiving there. And then again, when one expires, just add a new one with your funds that are available. How to manage these trades. Let's say it's going your way and MES is pretty much staying where it is. If it goes up or if it goes down a little bit, just let them expire. Those commissions are very high. Now, if any happen to reach all the way up to 0.3 delta, which is very rare because we're starting at 0.03 or so delta, MES would have to drop pretty considerably in the beginning of the trade. I would consider rolling them back by buying back whatever the current price is, selling a new one at the same premium. I'm not trying to get a net gain on this particular trade here. I'm just trying to break even. But in this case, the lower delta will be helpful to keep it a little bit safer. Did have to consider doing this close on one of the MES trades. We got near 0.2 delta. And at the time I looked at what the rolling at the same premium would be, and it brought it down to about 0.14 delta. So it does make it a little bit safer when you're keeping it at the exact same premiums there. And you could also consider adding another position at this point if you have the funds for it, because MES dropped quite a bit to go from 0.03 to 0.3 delta. There's a good chance that it's near one of its lows, and then you could sell another one, and there's a good chance of mean reversion, and MES might bounce back or at least stay where it is. All right, so that's the basics of the strategy. If you have any questions, leave a comment down below. I'll read and respond to all comments or questions that you have. If you would like one-on-one managing of these positions, help from me directly, and individual trades for 0DTE and monthly credit spreads and cash your puts, consider joining ThetaTraders.com. It's a free 14-day free trial, and the link is in the description down below. Again, I'm the investing teacher, high school science teacher, teaching others how to invest. Happy trading out there, be well, and see you guys next time.